following paid commercial program is brought to you by TD Wealth.
Welcome to Money Talk. I'm Kim Parley. Thanks so much for joining us. The conflict between Israel and Hamas has been horrifying. It's also raising questions about an intensifying crisis in the region and the worsening geopolitical environment. Here to discuss the implications for the markets, Michael Craig, Head of Asset Allocation at TD Asset Management. It's always nice to have you here.
Pleasure to be here, Kim.
So, putting aside the humanitarian side of this, which has been horrifying, when you look at this from a market perspective, what do you see? I mean, what are you seeing happen with regards to how it impacts the markets?
Well, similar to what's happening in Ukraine, this is a region where you're having a lot of oil being shipped, and so oil and various types of energy does get a bit of a risk premium put to it. You'll see it in the cost of volatility or insurance on oil. You saw initial lift in oil, and I think oil in general will trade with a bit of a premium now because we have some degree of uncertainty now about what might transpire from here. It might be a localized war, or it might draw in other actors, and then that way you could actually see a real material move in oil much higher. So I think that's the biggest issue for day one. Historically looking at conflicts in the Middle East, you have a big outcome of returns in the markets. There's actually been periods when you've had the market rally and periods where it's actually sold off. And the big determinant is whether the U.S. is already in a recession. The big periods when you had a real sell-off was in 2001 after the terrorist attacks in New York and 2008. And so I don't think, we have a poor market from here. It's not going to be driven from what's happening in Israel. I don't think it'll be more a function of kind of domestic economies and where we go from here as we're in the midst of this tightening cycle.
And I get, how do you, and you can't, obviously in the world, what's going to happen is going to happen in terms of, but when you think about like contagion in the markets or, geopolitical contagion and things worsening, it just sounds as you're saying that this is like an overlay onto what already is happening in the market. It's not going to turn the general trajectory of what the market was already going to do.
Yeah, well, but you do have to say there is a probability that more actors get pulled in, particularly with Iran. So if Iran gets pulled in this, which I don't think will happen, then like all bets are off, right? Then you've got a real, you're in a real jackpot because that you will see the American response. And now you've got a full-on war in the Middle East, not just within Israel and Gaza and the Palestinians, so Hamas. So this is kind of where, again, if it's localized, probably, this probably is over in a few months. But if it spills over, then you got real problems. And in that scenario, I think oil goes to, north, well north of the 100, probably 120, 130, maybe $150 a barrel, which would be tremendously, you'd think about a massive tax hike to a typical consumer because... Which
already with an inflationary environment.
Just take another real hit to your personal income.
Yeah. What if, when you talk about oil, I was reading, I think earlier where you see 50 years ago when there was conflict, they were using an example of conflict, in Israel and the Middle East, oil played had a disproportionate effect perhaps in the economy because there was, inflation was happening, recession, but also the world was much more dependent on OPEC oil, where it's not today. And so that really changes the dynamic, I assume, at the same time as well.
Yeah, but I also think the lesson, I talked to our head of commodities about this, there's a lesson that was learned by oil-producing states in the 70s, and that is if you push that price too high, the long-term implications are countries are going to figure out ways to reduce their dependency on oil. And so, yes, you might create pain in the near term, but long-term you lose. Ideally, what petroleum exporting states want is a reasonably high price that's not too volatile, where they're making, a reasonable profit off the spread between cost of production and cost of sale, but it's not so much that it's creating demand destruction. The last thing they want is everyone driving an EV, right, and not using oil as much. And so that is in the back of their mind that, if they're going to use oil as a weapon, you're really kind of cutting off your nose to save your face, if you will. So I don't think there's the incentive structure like there once was. Because of the lessons learned. Oil was kind of, in nowhere. In 1980s, 1990s, oil traded very, very cheap. And the 20-year bear market that ensued after the 70s. I think this is certainly on the back of their minds.
What about just if we pivot to the Fed, and the Fed, has had various speakers coming out talking about how maybe, that the bond market has done their work for them, and then maybe they could be on pause. What are you seeing now? How are you interpreting that? Or how am I misinterpreting it?
No, that's spot on. We have to step back and have a tremendous degree of humility right now, and I think Fed officials or Bank Canada officials are all in the same boat. It's like, what's going to happen, right?
Yeah.
They've just had this historic tightening campaign. In many ways, that's what is driving decision making right now. It's this whole concept of variable and unknown lags from tightening a policy, and they're looking to see, okay, what's going to happen from here? And I think what they're trying to tell you is, we think we've hiked enough.
Yeah.
But we're just going to wait and see how this plays out. And so then I think the debate is going to go not so much more whether they're going to hike again, but how long they're going to stay there at restrictive levels.
Yeah, and what do you think?
Oh, I think they're going to stay restrictive until they see a material sell-off in inflation. You know, the lesson of the 70s was that every time central banks hiked, you know, inflation moderated, but then unemployment started to roll over. And at the time, the mantra was, we want full employment. So they would ease right away. And sure enough, 9 months, 10 months later, inflation's back to uncomfortable levels. Nobody wants to make that mistake again. They might make new mistakes, but they're not going to take the foot off and say, okay, all clear, just because inflation goes back to 2. They're going to want to see it there and be confident it's going to stay there for some time. So I think we're into a higher rate period for some time. Yeah,
and I guess layer into that fact, too, what we talked about earlier is just if you do see oil prices go higher, that complicates things, right?
It does and it doesn't. I mean, it's certainly in your kind of CPI calculations, it's a spike. But I always think about that as more of a tax. Right? If we have to pay an extra $15 to the pump, it means $15 less to go out for dinner. And so really, it's a hit to our standard of living. It's a hit to our consumption, and ultimately, where you give on higher oil prices, you kind of take back in terms of other places you'd spend money. Unlike where you've got tight labor markets or you've got wage price spirals, what have you, which is inflation that kind of feeds on itself. This is very much more like a tax. In so many ways, it's almost like a hike. It's almost like an interest rate hike because it is reducing households' ability to consume.
You mentioned about wage spirals and things moving. So, I mean, we did get a fairly decent jobs report coming out. I mean, what are you expecting? Are we starting to see that market soften?
It's a bit of a random number generator right now. Not to get into it, but there's all kinds of statistical calculations used to formulate these. I don't think they've even really recalibrated them after the noise of COVID. And so I think that I'm kind of taking that with a bit of grain of salt. The last jobs report was way outside of anyone's expectations.
Yeah.
I mean, if we see a negative one next month, maybe we shouldn't be too surprised. I just think right now the data is so volatile, so choppy. ADP number was quite soft. You really don't have a good feel for what's happening in the job market, and the data we're getting just isn't really giving us a clear picture.
All right. Stay with us when we come back. A great explanation of what's happening in the markets. When we come back, Michael's going to talk about how investors could be approaching these markets. You're watching Money Talk. We'll be right back.